We thought we'll do something interesting today, get in board CIBIL and try and understand the trends in the retail credit market. But before that, Poonam Sani, my research colleague, has been doing her own internal research. And Poonam, over to you. What are the trends looking like?
Well, thanks so much for that, Aisha. In fact, very interesting data has been shared by TransUnion CIBIL in terms of the entire retail credit growth as well as the NPA trends. Firstly, of course, in terms of the growth remains fairly strong, and that exactly can be seen from the credit inquiries growing nearly around 30% in the last 5 years. The supply, which is denoted by the loan accounts open, that is pretty much meeting the demand, growing at 20%. It is also denoting that the entire financial system is fairly being slightly selective in terms of loans being lent to the retail credit. The unique potential borrowers as such have grown to nearly around 30% with 9.6 crore borrowers there. If you again flip up there, we're also seeing the growth in terms of the disbursement being at 16%. Now do note the growth in credit is 30%, the growth in disbursement is 16% odd, even the supply there, and hence this is denoted by that the average ticket size itself is shrinking slightly from 2.1 to 1.8 lakh itself in the last 5 years, just stating that more small ticket borrowers are really coming back into the system. But if you look at the entire NPAs in terms of the retail credit, more or less steady performance in the last 2 years itself. The overall retail NPAs stand at 2.3, now at 2.9. Interestingly, gold loan NPAs have improved. Personal loan remains more or less similar, but the home loan NPAs are rising from 0.7 to nearly around 1%. If you look at the auto as well as the two-wheeler loans, we are seeing high amount of delinquencies there with the auto as well as the two-wheeler, both coming pretty much higher. Look at the auto loans, the NPAs there rising from 2.3 to 2.9. But look at the consumer durable, right from peaking there at 3.1%, we are seeing some amount of improvement here back to 2.3% now in September, now around June of 2017 itself. So good amount of mixed trends there. I guess the home loan still remains a slightly tricky concern there, but we are seeing good demand and more or less steady NPAs across the retail pipeline.
Thank you for that. Well, for the longest time, like Aisha said, that we always tend to focus on growth aspect, what's gone wrong with the SME segment, what's gone wrong with corporates who are not paying up to the banks. But in this retail boom, what are the trends which are there at the retail lending level? You try and take a home loan, a car loan, and even if you want to buy an iPhone now, CIBIL score comes in handy because that really distinguishes you from a bad payer to a good payer, and the lender in this case is able to really judge your,
in today's terminology, your credit rating.
Your credit rating, yeah. I mean, it's a very effective way, and personally, I'm sure everybody has benefited because of the good work CIBIL and some of the other agencies are doing. So let me bring on board Mr. Satish Pillai, CEO of TransUnion CIBIL. Satish, fantastic to have you on it. It's your first interview, so welcome.
Thank you.
And a very warm welcome. First, let's talk about the big picture trend. If I look at the NBFC growth, at least at the retail level, the data points which we are getting from banks like HDFC, ICICI Bank, IndusInd Bank, numbers are enviable. But what is the inside story? They never tell me what is, they always tell me what is going right. They never tell me what is going wrong.
No, it's a great point, and we are a little paranoid as well to actually look at what's underneath the data, if you will. So you talked about banks, private banks, and NBFCs growing massive numbers, and I think the charts earlier showed as well, consumer durable loans, gold loans, personal loans, across each of those segments, right? What's underneath that at the first level, if you kind of peel back the onion once, you actually see delinquency rates, and we track this at a vintage level. That means that you can look at a portfolio that's very large and get confused by the numbers. We're saying something acquired in January, how's that doing relative to something got acquired in September, like 4 months ago? And we still see, is it holding steady, right? So we see that holding steady. We see there are some pockets, of course, where you might see a little bit of a blimp, but we see structural stability across all lenders on unsecured debt and secured debt. That's the first level of the story. The second level of the story kind of becomes around leverage, because there's a lot of paranoia and saying we're lending a lot to people. Are we actually increasing indebtedness? Is that going to create issues, right? You need access to credit but not. So we look at that, and banks look at that as well, right? So it's to the point of saying what the bank's not telling you. They are looking at these things, it's not that they are not. And they look at and overreacting to places where you don't over leverage customers. Now, leverage by itself is not bad. What we are telling them, and they are also understanding, and a lot of this is in partnership with them, is saying the type of leverage matters, right? So there, there are kind of three segments around this stuff, saying what you will see is High growth, kind of, there's a big piece around the high growth piece of it. Second transformation that's happened in lending, which they're talking about a lot, is in terms of digitization, but there's a S word in there that's like speed. The speed of acquisition right now. We all get credit cards, and right now we will expect a consumer durable loan, a loan for a TV or a credit card to be done in 2 minutes, right? 7 years ago, you are perfectly comfortable. It took 14 days for somebody to tell you if it's approved or not. That's a new normal right now. So speed has changed. So banks are doing well right now, also because of that element. And I think we played a part in terms of the infrastructure or making objective, making objective data available. That's actually there. The third piece is what's worrying, right? If you actually what's worrying is the slope of leverage. So if you will, saying just because you have 10 lakhs in debt doesn't matter as much as figuring out where you're coming from. Your score could be 800. Where is it going? So we are looking at a lot of those things. And all I would say is I think banks are doing well, lenders are doing well. There's solid retail growth, and you see that in the numbers. The market recognizes it. But there is a healthy paranoia, and thank God for that, across risk managers and business leaders across the board, where they kind of ask the question, are we doing this right? Can we do anything different? I think to me, it's a sense of remembering 2007 and 8, which is the most recent retail crisis, if you will. And if people remember that, and I think they do in all my conversation with the bankers, we all kind of lived through that, there is a healthy paranoia. So it kind of makes you want to bet on that, to saying, yes, growth will continue, but continue to be profitable.
Okay, so let's go segment by segment
Sure.
here. As I understand, home loan NPAs have actually risen to 1% versus the 7/10s earlier.
Right.
What's the segment which is not being able to pay up? Is it the salaried class? Is it the self-employed? And more importantly, do you see this NPA only picking up in the next few quarters?
Sure. So, and that's been a great segment that we've looked at, and we actually cut this down in terms of the amount, the sanction amount, right? So, home loans in urban cities, in Mumbai, for example, a much higher amount.
Obviously,
so we cut it down in terms of transformation happening in affordable housing. So we see some stress in there. The question is, delinquency higher, is that a good or a bad thing when you start lending into, let's say, riskier segments? So all of our conversations with bankers, you're not going to hear even home finance companies necessarily worried that they're saying this is happening, somewhat by design. As you start getting into sections which are financially excluded and getting in there, there's risk in there, but they understand that we're already at such low levels that their profitability isn't going to get impacted by this. That being said, it's to be watched. I think the affordable housing market still has a long ways to go before it actually evolves. You still see a lot of impact on this. So we are kind of watching that very carefully. Again, as I said, home finance companies are not overtly bothered right now in saying by design. You see that in every segment. I think credit cards and all big large segments. We start seeing going to tier 2, tier 3 cities. There you start seeing delinquency creeping up, and that happens because they understand they're getting into places where people are getting introduced to cards for the first time. And that actually might happen. So something to watch for, but I wouldn't call it a red flag yet.
Okay. So
Satish,
you're saying, sorry, that subscriptions are higher when it comes to the affordable housing segment.
That's right.
Now.
That's right. And that growth is definitely there.
Okay, I was going through your website, and you're talking about maintaining credit files for about 60 crore individuals and 3.2 crore businesses. That would be scratching the surface, because I think in a large part, India needs to cultivate a credit rating culture. Do you think that's happening? And do you think that banks as well as rating agencies such as yourself can work together in that direction?
No, absolutely. I think there is no such thing as done in terms of financial inclusion or literacy, for example. Right? There's a long ways to go. That being said, if you start looking at the numbers, and those are actually about 600 million is the number of accounts that have been, number of loans that ever been given. Right? It's actually close to about 300 million people who have got a loan. If you look at 300 million people actually got a loan, that's still a large number. Now, if you start looking at the adult population in India, you can say, well, there's still 300 million people out there. But it's also a function of how many people take loans, right? So I was talking to you folks in the office a little while before. Not too many people are saying, we are credit averse in some ways, we're debt averse. So I wouldn't say that we are, there's a whole lot that has taken a debt that we are not looking at. That being said, are there more people who need access for credit? Absolutely, right? I think the biggest segment there is small business. SMEs, right? There are 40 million who have never ever taken access to credit. There's a whole lot that we need to do. To answer your last point, I think that goes through education, and they goes through empowering them. So there are consumers who come to a website. There are 1.5 million consumers who come to our website every month, trying to understand. They're not looking to buy necessarily, right? They're looking to understand, why is this material? How do I influence or understand my credit rating so that I get access to cheaper funds if I'm applying for a home loan or I need a personal loan for something? I think I would love to see that happening with small businesses as well. and love to see a transformation that occurs so that a small business feels comfortable going to a bank and bank feels comfortable lending there as well. Long ways to go. I think we are, if you look at it as an industry, we've been around since 2001, but data started coming in 2005. So we're 12, 13 years old. Long ways to go.
Long ways to go. Well, appreciate your time.
Absolutely.
Hope to see much more of you going forward.
Right. Thank you.